Well, good afternoon, everybody. Is this working? It is. Excellent. So my name's Paul Davies. My academic affiliation is the University of Oxford, and I'm going to attempt to moderate this panel, which is talking about varieties of stewardship, reimagining E, S, and G. So before I say a bit about that topic, let me just introduce our panelists. So furthest away from me is Harlan Zimmerman, who's a senior partner with Cevian, is that how you pronounce it, Capital, who are activist investors. And then next to him is Anne Foster, who's a senior director of Quinsbrook Infrastructure Partners, and they invest or they focus on low carbon energy infrastructure. And then next to her is Shireesh Vasupalli, who's the deputy head of global active equities with the Singapore Wealth Fund. And finally, but by no means least, next to me, Caroline Escott, who's a senior investment manager with Railpen, which manages the assets of the rail industry's pension funds. So actually, that is quite a variety of different sorts of investment approaches and activities. And that's probably a good thing because we scratched our head a bit as to what reimagining stewardship might actually mean. And we thought on the whole we had sufficient difficulties in getting to grips with the existing version of ES and G without thinking of something different to puzzle us. But in the end, what we decided we'd try and do is identify the areas of ESG investing which we currently find difficult or challenging, and then try and draw out from that an answer to the question, well, does this mean that ESG investing has to be done differently in the future? Should there be more of it? Should there be less of it? Should it just be done differently? So that's the general approach we're trying to try and stick to. And what we did manage to agree on is a batting order. And the batting order involves Shireesh opening the batting, and let's hope in good Indian fashion, if that's all right, you'll make a century.
Hello, everyone. It's a pleasure to be here. Thank you for having us here. Just a quick intro from my side. This is Shireesh from GIC. And a quick intro on people who don't know GIC is the Sovereign Wealth Fund of Singapore. We manage the foreign exchange reserves for Government of Singapore. Having a client whose investment outlook is inherently long-term and who measures us on a 20-year rolling rate of return gives us this unique ability and unique luxury, I would say, having a single client and being able to truly invest for the long term. And that's what I would try to link up with the topic here in question. We invest across asset classes. We have a large private portfolio as well as the public side. We invest across balance sheet, invest globally with more than 40 years of experience. So that's GIC. Coming to the topic here, which is reimagining E, S, and G in this current environment. I would like to touch upon three specific topics related to this. The first is in terms of just talking about the principles that guide us as a global sovereign wealth fund, as someone who manages money for the long term. What are the principles that guide us in the area of ESG and sustainability? In terms of how it works out in practice, sometimes it does, sometimes it doesn't, and it'll be interesting to share more of these learnings. And the third is the part on reimagining, which is what Paul referred to as well. I was trying to link up reimagining with the current uncertain environment and what are the challenges that we face in this current environment. So let me start with the principle around what we follow as ESG. So the principle for us is anchored in the investment philosophy that companies and corporates with good sustainability practices will offer prospects for better risk-adjusted returns in the long term. And that's quite key for us. And as I mentioned, it aligns quite well for us with the investment philosophy and with our clients, which is Government of Singapore. It is supported by empirical data as well. A lot of you are academicians here. You must have seen some of this data where more companies which do better in sustainability have seen to offer much higher outperformance than the ones that don't. The second interesting thing is the difference also becomes much more marked over the long term. And the third is these companies also offer better downside protection in times of social and economic crisis. So that broadly forms a philosophy. Now let me talk about how it works in practice and what do we do in terms of our investments in practice. And broadly, we would look at our investments in two buckets. Just to simplify matters, especially in this environment, I would say there is the bucket of being defensive, and there is the bucket of being more on the offense. Being an opener, I can afford to be a bit more aggressive. So on the defensive side, what we're looking at from a portfolio perspective, having a sort of a large and diversified portfolio, is that the climate change represents and ESG risks represent a big risk for the portfolio. You need to identify those risks. There is a risk that more and more assets become stranded as some of these market externalities get priced in much more quickly than what the market valuations imply. And these may be due to the actions of the government, actions of businesses, as well as actions of all of us, consumers. So that's something we need to have a clear picture of. The second would be on the offense side. And this is quite interesting, especially relating to the discussion on the technology before. There are lots of innovative technologies coming around which can help reduce carbon in the environment. One such example, very recent one, in fact, that we invested in is a direct air capture technology, which takes carbon dioxide from the atmosphere and stores it away for good, called a company called Climeworks. It's the largest of its kind in the world. And it was a very interesting opportunity of addressing this multi-trillion-dollar opportunity where it's not just one technology. You need a lot of them to make even a small difference to this world. So it's a very exciting opportunity. We're spending a lot of time on it. What I want to spend a bit more when we talk about opportunities is also on some of the transition opportunities. And that's quite fascinating because most of the assets sit in this bucket of transition area. If you ask me as a portfolio manager on the public market side, if you ask me to build a net zero portfolio, I can do it quite easily, actually. I can invest in a bunch of tech companies which have net zero footprint. I can kick out all the carbon emitting companies, energy companies, mining companies, and the transition companies. And there it is. I have a net zero portfolio which I can market to my clients or to my client, Singapore government, and say that, you know, my carbon footprint is zero. My portfolio is great. It solves the problem for the portfolio, but not for the planet. In addition, you may also not be garnering the best investment returns investing in this type of a portfolio because from our experience, at least in the last few years, these tend to be crowded. These tend to be valued at numbers which are devoid of fundamentals. So it's very difficult to, again, going back to a philosophy, do these investments make return over the long term? And the answer is not very clear. So the most fascinating opportunity for us is these transition opportunities, where there's a lot more that can be done. What is needed here is stewardship, engagement with these companies. It's not a one size fits all. It's not about divesting away the assets that you own, which are heavy carbon emitters, but it's engaging with each and every company on a very sort of close one-on-one in a customized way to understand how they can transition into a more sort of cleaner company and a cleaner footprint. Let me just talk about the challenges now. So the third part of my quick intro is on, in the practice, what challenges do we face trying to align our philosophy with the long-term returns approach. The biggest one, especially in this uncertain environment, is trade-offs. In GIC, we love acronyms, and one of the acronyms we came up with recently was around these words G, I, and C. It's the uncertainties we are facing right now: geopolitics, inflation, and C for climate change. And these are the lens that we're looking through right now on the challenges before us and the trade-offs before us. A lot of times these trade-offs are around goals, around time horizon, short-term versus long-term, around ESG itself, which is something which is good for sustainability, isn't so good from a social perspective. We see it distinctly in the emerging markets. As we all know, you still need fossil fuels for the large populations to thrive and survive right now. So that's one of the biggest issues that we try to address through, again, close engagement and one-to-one interaction with each of these companies. The second one is, I would say, data. This is, again, it's a big topic, and a lot of stakeholders are addressing this issue. But as, again, especially on the public market side, it's one of our key challenges. How do we get data which is of high quality, which is comparable, and which is reliable? And there's a big paucity of that. We're still seeing some green shoots with COP26, for example, talking about incorporating in the financial standards. There are SASB standards coming out. So that's the only way that you can really assess the performance of a company and compare them across the universe, and also be able to engage with them once we have good data. The last one I would say is around governance. Governance, not in the traditional sense of corporate governance and the board governance. I'm thinking more from a global perspective. There are trillions of dollars of private investment which is waiting to be invested in climate change opportunities. However, there is a lack of proper design of investment vehicles which enable such private investment to go in to these sectors, and that's a big challenge. Unless from a government and regulations perspective we do that, it will be very difficult to get the investment needed. We think of the time, call it sort of 20, 50 years ago, when infrastructure was being funded by such public-private partnerships, multilateral organizations coming in, governments jumping in, providing the safeguards for institutional investors such as us to come in and commit large amounts of capital and earn a return on capital which justifies the investment. So a lot of that is needed going forward. I cannot emphasize enough the importance of that. That's as far as the challenges is concerned. So I've covered the three parts again. What I would end my sort of brief chat saying, this is a really important topic that we're spending a lot of time on. We're trying to align our long-term investment horizon with the returns objective for our client, because we think that's the only meaningful way of going ahead and satisfying both our stewardship objective as well as the planet. We don't have all the solutions. We are here to learn, especially from esteemed panelists such as I have here. So hopefully through the sharing sessions, we learn a bit more to do this job a bit better.
Hello, my name is Anne Foster. I head up ESG and climate at Quinsbrook Infrastructure Partners. Quinsbrook Infrastructure Partners are a global, essentially infrastructure, but also a tech investor. And we are investing in the energy transition. This is not just solar and batteries. This is all the other things that are needed to make it work. It's things like synchronous condensers that many people don't even necessarily know exist, but they stop blackouts, for example, that took over the UK a few years ago. And it might be the tech companies that bring batteries and solar together in an increasingly distributed grid. So that's the background from which I come towards stewardship. Now, some investors have kind of said to us, well, that's relatively easy. You're already doing climate change. That's the core of everything that you do. You're already working in energy transition. It makes it easier, yes, in some respects. it certainly makes it easier in the types of investors that we attract. There are some phenomenal pension funds and investors out there who are really driving change, and we work very closely with them back and forth to constantly make sure that what we're doing is echoing, as much as what they want to be doing, which is, an incredibly exciting kind of intersection, to be at. But I think, when we talk about, okay, well, how are we reimagining ESG? What do I think is going to be happening going forward? I think some of the commentary over the last couple of months has been, or weeks even, is actually indicative of this in an odd way. We've seen some big public figures come out and talk about how they think ESG is a load of I'm not a particular groupie of Musk, but in this instance, when we're talking about, are armaments ever okay? I'm not, completely sure they are either. So, in that instance, I might have agreed. When it comes to people talking about is climate, does it have a real impact on value? Yes, it does. It absolutely does. And we can see that today. This is not necessarily in 20 or 30, 40 years. We can see that in investment portfolios today. Brisbane or near Brisbane went underwater in 1,000-year flood levels were exceeded by 3 times. This happened about a month ago. There was a lot of other stuff going on in the world that didn't necessarily make the world press. But what we are seeing is 1 in 1,000-year events happening more and more and more frequently. And they're happening already. So as an unlisted infrastructure and business investor, our time horizons are today, but they're also 40 years out. And I think what, that brings me to when I look at what is one of the biggest things that I see in reimagining ESG, it is actually a concept of almost what I call single materiality. So we're being told that there's a double materiality that we're kind of working towards, that there's your financial goals and then your ESG goals. And to do them both, you've got a trade-off of some form. And absolutely, in some circumstances, you've got a trade-off. And we've got investors who've come to us and said, we'll take 2% as a return if what you are doing has the best social impact or whatever it is that we can do. But that's not your typical investor. It's, they're typically looking for significantly higher returns than that. But what I see day in, day out is time and time again, if you look hard enough and if you look far enough, you will almost consistently find that by improving your ESG risk mitigation, decision-making, opportunity assessment, you are able to better protect capital for your investors, and you're better able to seek opportunity and to help grow that capital. So, for example, let's give you one example. Human rights is a big area where it's something that everyone cares about. We don't really like talking about slavery. It's not a nice thing to talk about, but we all know it happens, and it happens all over the world. Every so often, particular parts of it make the headlines. So in the US, that's been, particularly with the We Forced Labor Act that's come into force, and even more in June in relation to forced labor in the Xinjiang province. We very early on put a hard line on our investments in terms of how we were going to address suppliers. And I'm going to say to suppliers all over the world, contractors in Texas as much as the western parts of China. This is not something that is specific to any part of the world. But we put in a hard line when it came to our assessment. What that meant was that a year later, regulation came into force in the US, and we'd preempted that. 3 years later, we're able to get solar panels through customs in the US when a lot of solar projects are falling down or cotton or tomatoes or other things, because they can't get them through customs, or because they're at risk of not getting them through customs anymore. So while we might think that these are nice things to do, the reality is time and time again, this is actually a single materiality, and what is happening on ESG is impacting what happens on the bottom line. And I hear sometimes people say to me, I don't really necessarily get this ESG thing, it's new to me. And I say, well, do you get that you can't use certain toxins in frying pans anymore because you might have a litigation case come against you? And people understand that, or that you have to look after health and safety on a construction site, because if you don't, it's going to have ramifications. This is all just an extension of that. People understand those things, and this is all, kind of an ongoing extension of those. I think that the second thing I think that is going to happen is a solid ESG integration. This is what we've done at our firm. ESG is not sidelined. It is part of our investment committee. Every investment committee decision is the responsibility of everyone in the firm to look after in exactly the same way they address every other risk or opportunity. And that's how we see it. That's how intrinsically we see it in our valuations, in our investment. And I think that is something we're going to increasingly have to see, because you cannot steward properly if you have one person in the firm or a group of people in the firm who are looking after it. You can have a group of experts who are helping guide everyone as to what to look out for, what to be across, but it's got to be the CEOs, it's got to be the people on the ground, it's got to be the analysts or the operational team. There's got to be everyone who is educated across stewardship and what is expected, and that everyone is looking out for that risk in the same way that a BHP Billiton, I think that's an outdated name for it, but anyway, that was when I advised them. In the same way that they're looking out for operational risks at each level. And the third thing that we're going to see is simply the ability to need to make things measurable and material. I think there's also room for anecdotes too. There will always be room for anecdotes, because that's how we get sentiment, that's how we get power across to people. But we are going to have to see increases in measurability and materiality assessment, and we're already starting to do that. Carbon is one of the areas where you'll see that start to happen. Groups like Trafigura and others have brought in blockchain accounting, where you can start to actually assess what are the human rights potential. At least let's try and put a tag on what the human rights are from a mine site to when we receive a commodity in a battery, in a lithium battery. What's the carbon footprint of a piece of spodumene that's gone through into a battery? So there is technology that will support us in this, but that is going to take time. But already what we're able to do is to say there is a material assessment that we can make here, whether it's climate, whether it's something else. As investors, we don't always know whether the operational costs are going to go up or down, or the capex is going to go up or down, but we can make a broad assumption on it. We can say it might be 10%, it might be 10% up or down. Let's figure that out. And with the same thing with ESG, we can apply those same metrics and that same risk parameters around it and say, what could go wrong? What could go right? How can we assess that? And we can start to adopt a materiality framework across a mass of things for ESG. I think, as you were saying, in terms of imperial evidence, Harvard Business Review came out a while ago, and basically they saw that 70% of revenues of businesses are at risk because of ESG, and that's how we view it. We don't, I don't think it should be something that is seen as a constant fighting forces against each other. I think when you look hard enough and far enough, and I think that's what we're going to see in future, they're going to start very much to intertwine.
Thank you very much.
Thank you. Yes, Caroline Escott from Railpen. We are the in-house asset manager. We do have this one client, but we also see ourselves very much as an asset owner. So we think of ourselves as a pension fund, even though technically that's not quite right, but it does influence a lot of the work we do, and we think it gives us a certain purity of purpose, which I'm sure is familiar to others on the panel. And when I was chatting to Dionysia about reimagining ES&G and thinking about the link to stewardship, and stewardship is putting responsible investment into practice, and it's about having a real world impact on the ES&G issues at the companies in your portfolio. And in order to influence, investors need to have a voice, and company management needs to be incentivized to listen to that voice. So today is to talk a little bit about what I see as the need for the investor practitioner community to reimagine the G, and in particular to take a fresh look at what is a very fundamental issue. It's probably the biggest corporate governance bugbears for us, for other investors, and I'm sure for this audience, and that is dual class share structures or unequal voting rights. And yeah, that chuckle Paul said everything I needed to know. Because when we are thinking about stewardship in an uncertain world, we and other investors need the tools to be able to make our voices heard, and make them heard on whatever it is that is coming down the path in the future. So for this audience, you'll be very pleased to hear that I'm not going to go into the details of what dual class share structures are, what the academic evidence base is, because you will all know the issues in the academic evidence base and sort of both sides of the argument to a certain extent much better than I do. But what I would like to spend a few minutes doing is providing the practitioner perspective on recent policy developments and our assessment at Railpen as to what the investor community, the investor practitioner community response has been like so far. So we see, I think everyone sees, that policymakers around the world have been increasingly receptive to measures to further enable dual class share structures. Obviously, we've had this in place for quite a while. Started off in the US. In fact, one of my US collaborators on something we're going to talk a little bit about later apologized to me for this corporate governance virus. He said that it spread across the world from the US. He didn't quite try to take it, explicitly do the parallels with COVID, but clearly that virus terminology was very much at the forefront of his brain. CII, who've been doing some amazing work on this, noted that in the first half of 2022, 24% of companies that IPO'd had some kind of dual class share structure arrangement. And in many cases, that was with a very sensible mandatory, sort of sensible sunset clause, 7 or 5 years, but not always. And this was a marked increase upon activity in the previous year and the previous year before that as a proportion. We've seen activity Tokyo Stock Exchange, Hong Kong Stock Exchange, Singapore Stock Exchange, most recently in the UK as well, all sort of shifting towards further enabling of dual class share structures. And we're probably all aware of the reasons to why this is happening. Professor Galloway, this wonderful phrase that many of you will have heard before, the idolatry of the innovators, and this really quite understandable desire from policymakers to try to encourage high growth, disruptive, often founder-led tech firms to list in their jurisdictions, are thinking about what it is that founder-led firms would like to see, and they're being told that the ability to be able to maintain control and take that long-term perspective that they talk about would be enhanced if we were able to keep as much voting control as possible. And I'm going to unpack the stuff that's been happening in the UK with the Hill and Khalifa reviews a little bit further, and partly that's because it is my home market, as it were. So it's something that Railpen has been engaging in quite extensively, but partly because I think the specific example brings some interesting broader issues to light. So enabling listing on the premium listing on the London Stock Exchange for companies with dual class share structures, that was put out to consultation. Railpen responded in our own right. We know that many of the investor trade associations responded. We fed into those responses. Some of them are even in the room, and we contributed where we could. Some investor associations we spoke to did put in a response, but said, Railpen's really one of the only individual investors talking to us about this, which I think is interesting, and I'll come back to that later. I don't think there were that many individual investor responses. One of the points we made in our response was the need for a coherent perspective from across government. So governments are telling us, quite rightly, that pension schemes, investors need to be more effective stewards of their assets. Brilliant. We are very, very, very on board with that. But at the same time, they are taking measures that actually mean that we might be trying to have an influence and trying to influence for the good, trying to influence corporate behaviour for the better, with one hand tied behind our back. That was a point we made, and I'll leave it there because I'll talk a little bit about some of the broader issues. Now, of course, the outcome from the Hill Review and the Khalifa Review and the FCA implementing consultation that followed afterwards was the implementation of actually some pretty sensible corporate governance safeguards that we were in favour of. Ideally, we would have preferred not to have seen DCSS enabled in a premium listing to begin with, but it felt like that was the direction of travel that had been decided upon. And so, we were sort of happy with where it ended up. So the broader points. There has been, particularly in the UK, but also elsewhere, so much good work by policymakers on environmental issues and increasingly on social issues, and trying to get private investors, institutional investors to act and to influence and to engage. When we speak to these same politicians about governance issues, or try to speak to them, about voting rights, but also about governance issues more generally, it didn't feel like there was the same sense of excitement. And that could be because in the UK we still have, great corporate governance standards. We've got the UK corporate governance codes. London is renowned, and rightly so, for being sort of a leading market when it comes to corporate governance. It could be because it's a bit dry. Maybe it's because, and I'm just putting this out there, the investor community maybe doesn't necessarily engage. Investor practitioners individually don't keep up as much of a fuss on it, or maybe it's just because there are too many things to concentrate on in the ESG space. And I'm happy to have that discussion. Channeling my inner Carrie Bradshaw for a second, I can't help but wonder whether, had Railpen decided to prod a few more of our friends and colleagues to put in individual responses along the way and to knock on the doors of policymakers who were taking the decision around dual class share structures and Hill Khalifa review, whether or not we might have had a little bit more influence. I don't know, it's hard, isn't it? Because some policymakers tell us that they like to hear from the membership associations. They like to have one solid response that feels like it's representative of a particular industry. And other policymakers say that there's nothing to quite beat the practitioner perspective, the individual practitioner perspective. And they quite often go out to practitioners to ask their views on various things. And quite often the practitioners are, well, we've got lots of other things to do. We don't necessarily respond in the way that we should be. If we had coordinated investor practitioner activity more, could we have been more effective? And then the third thing is that I think there's a feeling from some investment practitioners in the UK, but also more broadly, that things maybe are going in a good direction. Maybe in the UK that was fine. It's a different issue in the US. That seems to be worrying China as well. But in the UK, it ended up in a safe place. The battle is sort of won here. And I don't think that's the case. I don't know if that's me being overly pessimistic. There are rumblings all the time that tech firms and founders are going to policymakers and saying the changes you made to the UK listing regime were brilliant, but they don't go far enough. We need more. So it always feels like DCSS debate is in constant danger of being reopening. And of course, yesterday, the FCA published this discussion paper about moving to sort of a single regime. And it does talk about DCSS. And I actually think the FCA is quite pragmatic, and I think it's open to the investor voice. But I do worry that's another opportunity for people to have their say, maybe roll back the corporate governance safeguards that we worked quite hard to put in place. So I think it feels like sometimes there might be a little bit of complacency creeping in. And so this brings me to something that Railpen, together with some other investors in CII, is trying to do on a practical basis to sort of reimagine approaches to corporate governance. And so we, working with the CII, and a couple of other pension fund investors with a combined level of assets under management of around $1 trillion, are going to be taking a fresh look at this really old, long-standing issue, and to try to work in a much more coordinated fashion, and to try to think in a slightly new way about the levers and avenues for influence. We are trying to be pragmatic. We haven't yet launched. We're going to be launching in a couple of weeks. So this is your sneak preview, you lucky things. We're going to try to be pragmatic. We're not saying dual class share structures are always wrong. There might be a case for some firms at an early stage in their journey who might be prone to a takeover to have DCSS and listed as DCSS for 7 years, 5 years, but we think they should have a sunset clause in place for about that period of time. We want to do a bit more knocking on policymakers' doors with $1 trillion of assets behind us in the US, in the UK, and some of these key jurisdictions where we think there might be an opportunity to influence, because we've got a change of administration in the SEC, because there are consultations coming along the way in the UK as well. And we're also going to be trying to engage with pre-IPO companies, but companies that are sufficiently early stage in their pre-IPO journey where we might have an influence. And we've started the conversations with some of their advisors as well. There is a mood shift that needs to happen. There's a lot of careful messaging that needs to happen as well. In fact, there's lots of things that need to happen, lots of different levers that could be pulled, and we're not under the impression that it's going to be particularly easy. I think we're in it for the long haul. I think it's multi-phase, multi-year, but we think that the potential benefits are worth dedicating some resource to over the next few years. So yeah, my argument has basically been, if we're looking to the future of stewardship and reimagining approaches to E, S, and G, it's important for us as investment practitioners to get back to basics and to not think the battle is won, or to think that it's too hard to crack, or it's been around for too long, or minds are never going to change. But to try to use new mechanisms, use the levers at our disposal, use the critical mass. You know, we're starting off relatively small. We're hoping to expand the coalition over time, and to try to win the debate, because ultimately, if we can have even a tiny bit of success, that could be quite powerful for investors dealing with a very uncertain future everywhere. Thank you.
Hi, sorry. Could I just cut in really quickly? If we could just ask people standing and sitting there to go and move to their seats and get comfy, just because I'm conscious you've all been waiting a while. Cheers.
Conversely, if it's okay with you, I'll stand up. I haven't been in a classroom this long for about 30 years, and I used to fall asleep in most of my classes, so I think this is a safer approach, if that's okay. So I'm Harlan Zimmerman. I'm from a firm called Cevian Capital. I've been asked to, number one, tell you a little bit about our approach to ESG as an activist. I will also then tell you what we have come to believe is something that can have a systemic impact on improving ESG performance of listed companies. And number three, I'll very briefly give you a view on reimagining ESG. So first off, on Cevian Capital, we're often called an activist investor. We invest exclusively in European listed companies. We buy usually 5, 10, 15, 20% stakes of a limited number of companies such as ABB, Ericsson, Nordea, Rexel, here in the UK, Aviva, where we support the CEO regardless of gender or irrespective of gender, and also Vodafone recently we've been in the press for. And we've been doing this for about 20 years, and essentially and it's good to see some friendly, familiar faces and some maybe unfriendly, familiar faces as well here, and some new faces. What we do essentially is invest in sorts of companies that typically other investors don't really want to own. Their job is to invest in good companies that are doing well, and we see our job as investing in the companies that people don't expect to do well, and then try to engage with them and try to get them to do better. And historically, that has meant focusing on companies and trying to identify improvement potential or value creation potential in areas such as operational improvements, strategy structure changes, financial improvements. And usually the enabler to do that is improving the governance of the companies. Because if you have a company that, let's say, has good core assets, but isn't performing nearly as well as it could be, well, actually, that's a governance problem. If it has a long-standing operational underperformance, if it has the wrong strategy, if it has the wrong structure, if it has the wrong financial situation, who's at fault there? The board, management team, shareholders in the ownership structure, and we've very much focused on the boards. To improve the companies, let me just say that the single most effective way to change thinking and behavior and create accountability that we have found in our 20 years is creating the right incentives and the right accountability for management teams to do the right thing. Now, I'll just pause there. I've foretold a little something for some of you. Just pause there and say that. So the G has always been very important to us because it's been directly linked to getting companies to perform better and to create more value for everyone over time. The E and the S historically have essentially been risk factors. We are long-only investors. We're not shorting. We're not hedging. We're fully exposed to banana skins and big problems. And therefore, historically, we just stayed away from situations that might get too messy on the E and the S side. However, about 4 years ago, we began to understand that, wow, actually, E and S, if it's done well by companies, is also part of value creation, is part of making companies better, more sustainable, and more valuable over time, not just for shareholders, but for all other stakeholders as well. So we began to look at E and S differently. We began to do benchmarking as we do on operational potential and strategy and structure potential, also on the ES and the G. And we began to try to engage with our companies to advance also E&S improvements where we felt there were value creation opportunities, i.e. they weren't doing things well enough. We struggled. We found, even in our portfolio of 10 to 15 carefully chosen companies, too much greenwashing, too much activity at the level of, say, on the investor side, not just ourselves, but stewardship teams working hard, maybe even working with good sustainability people in the companies. But typically they were about 3 or 4 levels down in the organization. And very often the boards had no idea what those conversations were about. And the best ones were rubber stamping sustainability plans. And we had a bit of a light bulb moment. It's about incentives. We're asking, if we take climate, for example, we're expecting CEOs of companies today to lead the companies to face maybe the single biggest challenge that any of those companies have ever faced over the next couple of decades. And those CEOs are going to be gone in 3 or 4 years on average. So do they have an incentive to do what's necessary today and tomorrow and the next year to hit the 2030 target that they put out there, or the 2040? No. Actually, many of them have a disincentive to do that. And so we realized that executive incentives, i.e. compensation, was a way to try to bridge this gap. And therefore, we, a little more than a year ago, announced our first ever public policy that we thought all European listed companies should incorporate into their pay plans ESG metrics that are, number 1, tied to strategy, number 2, measurable, and number 3, transparent. And I'll come back to each of those because it's crucially important to get the metrics right. Bad metrics are worse than no metrics, actually. And so, and we said, not only did we think this was important, we put our own companies on notice that in 12 months' time, we'd be voting against the pay plans of companies that didn't reflect this, or to be specific, vote using our governance rights to vote against pay plans or directors or whatever we felt was appropriate. And so we wrote to our companies in advance. We told them this. We made a bit of a splash about it. Apparently, no asset manager of size or note had kind of said, do this or else. And we've been engaging on this topic quite widely over the last year. I probably had 150 different conversations, not just with companies and other owners, but asset owners and remuneration consultants in particular. And why do we think this is such a good idea? Well, number 1, obviously, if done, this is all based on the assumption that you're doing it correctly. But number 1, because it's providing incentives and accountability for management teams to do the right thing, even when they don't believe in it. And I think we can say that most of them don't believe in it. If they did, we wouldn't be in the situation we're in today in the world. So we need to give them the incentive to do the right thing and create the accountability, the real pragmatic accountability, hitting them in their wallets if they don't do the right thing. Number 2, our approach is not to go to every company and say, you need to do this. It's to go to the boards and say, hey, you're getting paid, we're paying you, you do your homework, and you come back to us and other shareholders and say what you think the right metrics are. The metrics that are tied to your strategy, that are going to create long-term value, that are measurable, and that are set at an ambitious level so that we, other shareholders, other stakeholders can see what the company's real ambition level is, and that you're going to be backing it up by tying the CEO's pay to it. And the design of that was we wanted those people in the boardroom to actually do the work, to say all of a sudden, hey, that sustainability person that we saw like a year ago, get them back up in the boardroom, and let's have a conversation. If we have to do this, let's at least do the metric that makes the most sense. And we could see we're in the boards of the majority of our companies, meaning our own people in the boards, so we can also see what's happening inside. And this is absolutely what happened inside the companies. All of a sudden, because they had to, because it was tied to pay, because it was, and pay is super important for them to get right, but also because it became a very public issue, they began to look at sustainability in a very different way. And we're quite confident that a number of them came to the realization that actually this stuff isn't half bad. If you do it right, we can now actually see how it works and how it all fits together. That's number two. The second reason that we think it's a good way, because it can crystallize new thinking and new behaviors also in the boardroom. The third reason we think it's a good approach, and we're operating kind of at the sharp end and in the real world and usually trying to be very pragmatic. Well, here in Europe, as most of you know, we have something called say on pay. And in some countries, it's super powerful. In other countries, it's less so, but it's still quite powerful. And so to go to a company and say, we are going to vote down your pay plan unless you do this, that's super powerful. And it's an existing right. This is the fourth aspect that we thought made sense. It's an existing right. It's a right that big institutional investors are voting on pay plans all the time. Increasingly, they're voting against pay plans. It doesn't require someone to call an EGM or launch a special motion or something, or a proxy fight, or some new legislation that we're waiting for the EU to adopt, or whatever it is. It exists today. And so it's easy to use power that exists today that everyone can use, that can force boards and management teams to work and behave in a different way, provided we get it right. So I just wanted to take 1 minute and say how crucial it is. What does not work here? What is the biggest problem with this approach? Biggest problem is that the targets are not good, the metrics are not good, and CEOs just get paid for stuff that they should be doing anyway, and the levels are too low, and we can't see that they've actually changed anything. And that's a real concern. And the way to address that is by ensuring that the metrics are, number one, very measurable, so we can actually see what the metrics are. They're tied to real world numbers. There's something called a management scorecard, which is usually in the annual incentive plans of CEOs, where the board says, well, 30% of their bonus is going to be the board's discretion based on our view of reputational management, risk management, leadership, and fuzzy things like that. And some companies have just added ESG to that so they can say that they have ESG in the metrics. But actually, I believe the academic evidence shows that those sort of non-quantifiable metrics, they always have much higher payout ratios, and they don't actually change behavior. So they need to be measurable. They need to be very specific things. And then thirdly, the metrics themselves need to be transparent so that we can actually see what the numbers are, so that we can see that the ambition level is high enough as well. And there is a trend. I should say that we did not start by saying we need to turn the battleship 180 degrees. This was already a trend that was happening, but it's accelerated a lot, and we and others have perhaps played a role in accelerating it. I think the majority of FTSE companies already with this AGM season have some kind of metric, but the important thing now is making sure that the metrics are good enough so that they actually do the job that they're supposed to do, and they don't also discredit the whole approach of using ESG metrics in pay. In 1 minute, reimagining the ESG, the S and the G. If I'm asked the question, do I think ESG will continue to be a thing? I would say, I hope not, in a way. I don't want to be too, would it be like Kirkian? Is that would that be right? But I hope it doesn't continue to be a thing, because if management teams and if boards and if organizations really truly do begin to integrate and embrace ESG as something that over the long term creates value for shareholders and other stakeholders, then it's going to be natural that the need, say, for those specific metrics in pay are going to fall away, because everyone will have seen that it creates value. It will show up in share price. It will show up in TSR. It will show up in profits. And so in the long distant future, maybe 10 years from now, if we're all doing our jobs, hopefully those ESG metrics will no longer be necessary. Okay, thank you.
Well, there was a lot of really interesting material in those presentations. Dionisia, have we got 20 minutes left? Is that all? That is terrible. Okay. No, glad you did. Look, I'm going to ask one question, which I hope will be a bit provocative for all the panel to have a go at. And then I suggest that anybody else, after the panel have answered, anybody else in the room who wants to make a contribution on that topic, or indeed online, should do so then. And only after that will I move on to the second question, if there is one. Okay, so look, as I listened to Anne and Shireesh, I got the message that in the long term, I mean, putting on one side what Kane said about the long term, in the long term, there's no conflict between ESG investing and financial returns to shareholders. But in discussing how you do ESG investing, you both mentioned that there were trade-offs. Harlan, on the other hand, seemed to think you could integrate all these ESG objectives into a single matrix for the purpose of pay, at least. Though what I understood him to be doing was not developing this matrix himself, but making the board of the investee companies do it. So that's a nice way forward. So what I want to ask is actually not a question I have formulated myself, but one which Jeffrey Gordon shoved into my pocket as I came down here. He says, I trust your panel will tell us how to integrate into a single number all the diverse objectives of E, S, and G. And then he, in brackets, says, we can't even properly risk weight assets on a bank balance sheet. How do we do the weighting here? And this seems to me an absolutely fascinating question. I wondered if you had responses to it. Who would like to have a go?
It's definitely a challenging task to do. I would say almost impossible to reduce it to one metric, especially the diverse factors involved in all the three variables. So I can share what we try to do at GIC, for example, especially putting this ESG in practice, one of the most important things or tools that we found very useful is a SASB framework. The SASB framework, for those of you who might not know, flags what are the most important metrics that one needs to track in a given sector or for a given company that has the most impactful or most impact on financial performance of the companies. Right. So if you have, let's say, within a consumer sector, you have an online retail player, you know broadly which are the key factors which are on ESG metrics which are most impactful for financial performance. And that's a tool that we use to engage with each of these companies on a one-on-one basis, especially the companies that we own, to understand how these companies fare on these sustainability metrics. What are they doing about it? Are they firstly disclosing some of these metrics? And if not, they need to start doing that. And we track them on an ongoing basis to make sure that we understand the progress of this company and hence potentially project how these companies could do in the future. So it's just one of the tools, but at least it's a broad framework rather than sort of one single metric, which hopefully continues to develop further investors.
I have to admit, I wouldn't try to reduce ESG to one number any more than I'd look at a P&L without a cash flow statement or a balance sheet or otherwise. I kind of see them a little bit the same. You need to have information, a lot more information than just one piece. If I was going to narrow it down to one, NPV is in fact one of them. Again, going back to that fundamental idea that there is inherent a positive financial impact. Yes, there's negative in some instances, and yes, there's a trade-off, but so many times the trade-off is so much less than people actually think it is. And in fact, the trade-off is a positive one. As I said, when you actually look hard enough, yes, you might pay fair wages, but the benefits of that, you can just as equally, plug into a model or otherwise, and you can boil it down to something that has some form of materiality. So I think over time, we're going to see that all of these things are factored in financially as well, and they actually do boil it down, to an NPV. In other, any other means of measuring it in one format, I wouldn't try, and I couldn't do it because I need far more information than I could ever get from one piece of information, and so do my investors. I might be able to boil it into a few more than one, to something that is succinct, that is relevant to their holdings or otherwise, but it's we want to get as many numbers as we can there to address the whole point that it has to be measurable. But you certainly, I'm not going to be trying in the near future.
No, those are good answers. I agree with my fellow panelists.
And I'm pretty much going to say that I agree with them. But the one thing that I did want to add was, so we use a lot of data providers, and I agree. There's no single metric. You can't boil it down into that. We wade through the methodologies of each of these data providers, and we actually think it's absolutely fair that a data provider will rate one company one way, and because of a different methodology at another data provider, they're ranking them, they're rating them in a slightly different way, or sometimes in a very different way. And as long as the investors understand the methodologies, we can live with that. One of the things that came up for us actually when we were thinking about pulling together a forward-looking governance exclusions process, so thinking about where we think the next conduct issues are going to happen, made us think very hard about what the governance red flags are. And we looked at our data providers, and there was no one data provider that had what we thought were the key governance red flags. Not all of them. They might have one, they might have two, so we had to look across the whole range. And that got us thinking that maybe we can do something ourselves. So one of the things that we at Railpen are working on, it's in very early stages, is trying to pull together our own proprietary methodology, which doesn't have 230 different data points, but it is based on our understanding, the understanding of other experts that we're liaising quite intensively with, around, what are the key things across ES and G to look out for, how do they differ across different sectors and so on, but what are the things that should make us think, oh, hang on, either we exclude it if we're going down that route, or we need to engage much more intensively on this particular thing. So that's just.
Thank you. It seems to me that what you're saying really is that these are incommensurables. So we're going to have endless incoherence for the future. Now, I've got so many hands. I've got Dionysia here, Dan, Jeff, gentleman at the back, two gentlemen there, and that is all we're going to have time for.
I'm going to keep my questions for the coffee break, but I'm going to ask some questions that the online participants are asking to give some priority to the online ones. So one question for Harlan from an online attendee.
Does it relate to this issue of
Not
producing a single metric?
Not really. I'm afraid, no.
Could we concentrate on the single metric?
Okay, and we move to the online.
Well, I have something controversial to say. Why do we need a single metric? I mean, how many people believe a share price is efficient and correctly encapsulates everything? I don't.
Yeah, but a lot of trading firms use
why, just because they use them, why do we need to come up with the answer? You know, I don't believe a single metric works.
It's a very simplistic way of reducing.
Yeah, without the mic, we can't hear you.
Okay.
Sorry.
No, I just want to completely agree with Harlan. I don't understand why we need a single metric, but you're right. There are a lot of firms that provide a single metric, like one ESG rating, AAA, AA, and I think it just circumvents the entire exercise required by good stewards of capital in order to be able to do the analysis. I know a number of firms just follow that as investing. Our portfolio is only AAA, MSCI, ESG ratings, and that's it. Like, but do you really know what is happening within that? Like, do you understand the criteria, how they could move 10 years down the line? And what happens to all the firms which you've excluded? You're not helping the planet, as I mentioned. I mean, you're probably having a portfolio AAA, but it doesn't help in any way that they end up in private hands, for example. If they're excluded from public markets, they end up in private hands where the disclosure is even poorer. So you are just worsening the problem by going by a single rating methodology.
Yeah, so this is I guess building a bit on the single metric, but you know, it struck me when Shireesh was talking, and then Harlan's example was climate, right? And when we're talking about a single metric, do you think that the ESG term is useful? I actually thought what Harlan was going to say is that we should throw away the term entirely, but you went in a bit of a different direction. You know, it seems like climate is distinct, right? Where you can develop these metrics, and maybe there are some other things that could be similar, wages, but everybody in this room knows that when you talk about ESG, you can read a million things that go under this title. And sort of Paul started there when he said he talked to the group and they were trying to figure out, you know, why are we reimagining this if we don't even know what it is in the first place? So I'm just wondering if you talk about that. Maybe it's not a single metric, but maybe it's actually defining clearly quantifiable areas within the ES and G where we can actually have some sort of coherent discussion and strategy, because it doesn't seem like there's a whole bunch of examples that are being brought up aside from climate, which seems to be agreed upon and important. And would it be best to take that out?
Yeah. Obviously, like, I deal with climate a lot, and therefore the ESG for us is in some instance very separate. But ESG, one of the issues with bringing ESG down to one piece is that ESG covers an entire business. It is not separate to a business in any way, shape, or form. It is the whole business, how it functions, how it operates, everything about it. So I think that's one of the things. Kind of aligned with what Harlan's saying, what I see is across globally, you've got investors, let's say in Nordic regions, often that don't even really differentiate ESG that much anymore. It's just part of their investment process. It's not, sometimes there might be a little bit with ESG, and interestingly, that's more just about climate, putting numbers around climate. But so much of what in other parts of the world might be considered ESG is just part of the standard due diligence. It's not even sort of separated from it. So I think that's one thing that may radiate more globally is that it does become, as you said, it's just part of sort of businesses. But in terms of single metrics, what I do find that is helpful is, yes, I do find that there are single metrics that can be helpful. So climate, you've said that's not one we're going to dwell on, but yes, you can bring that back now that we've got emissions modelling and carbon pricing. You can bring that back to a single figure that represents the value at risk across a company due to climate. It gets harder. So first we have to acknowledge it is going to be harder. We are not going to have all the examples at once, but things like the SFDR and the way that the EU has brought in a very clean, non-shiny template to ESG. Get rid of the shiny pictures, get rid of all the other things, and just bring it back down to some key numbers. And as much of a headache as that might be for some people, I've also found it one of the more useful ways of assessing and looking at ESG because it brings everything back to some raw numbers. Let's take equity and in pay as an example. There is one equation to use for equity and pay in that statement. You can't fudge those numbers. You can't pretend that someone's senior when they're actually not senior and put them in your senior ranks and therefore pretend that you're more diverse than you can, or you're paying people. There is no way that you can shift around. It is one formula and one number that you're reporting on. And that is when I do find it becomes incredibly helpful. Now, it's not one across the whole of ESG because that's like, I just don't see how that's any more feasible than a share price for a whole company. Not saying it's not feasible, but it's the same thing. But I do see there is definite value in that growing capability for us to put single metrics, single formulas, and simple ways of measuring things. And we've started with what we can measure. And there's a heck of a lot we still cannot measure. But as time goes on, we seek to improve them. We do what we can, we measure what we can, report on what we can, and then we constantly try and improve it.
I don't think the problem is the term. It's not a great term. The problem is the complexity of the issues and the differences. For in our portfolio we have Pearson, which has really no climate issues, but it's education business, and we have ABB, which is an industrial engineering company, completely different issues. And I think so the problem is the complexity and the need for both companies and investors to deal with the complexity and not just greenwash things on both sides. I don't think the term itself is a particular problem. If we don't say ESG, we're going to have to say sustainability. We're going to have to say something else in its place. So.
Boss, do we have any? Do you have time for one more question?
I'm still Bornesser. I'm a consultant. I wanted to come back to this point of the sort of the single metric, and it's very hard to imagine any other single, all-encompassing metric rather than the share price over time. That's my take on it. But when it comes to multiple metrics for purposes of incentives, the whole game is on the weighting of these things. And with the board making a decision on the weights, it invites, without any sort of, let's say, leeway to award things on a qualitative basis or on a balanced scorecard basis, but being, as Harlan suggested, very, very much anchored in a quantitative basis, so automatizing this, making it sort of automatic for the people, in a sense, the compensation. If one goes there, what might happen, and I wanted your thoughts on this, Harlan, is that you have unintended consequences, as you had with the financial crisis, which brought the whole financial system down because it was too far linked to some metrics, or you invite strategic behavior. So we are doing a big study on sustainability and incentives in the largest 30 European banks. Global banks, ex-Asia. So if you look at there, the Europeans have very specific, I would say, weights in there. They say 10%, and some of them are very specific about the measure, so they automatize the whole thing. Now, if 10% is for this, for ENS, let's say, a basket of ENS metrics, and 60% is for ROE, I mean, this predicates a certain behavior, and unless you're ready to say, okay, everything is equal here, and improving your climate footprint, it's as important as improving your ROE, which I don't think any of you is ready to do.
Maybe in the interest of time, so
the question is clear.
I'll also answer in a very summary way. Happy to speak with you over the coffee break. I mean, first off, number one, I'm not against management scorecards existing. I'm just against ESG metrics, or sorry, ESG being put in management scorecards, because then it doesn't happen. It doesn't change behavior. It doesn't change thinking. That's the truth. But management scorecards for other reasons, by all means. Secondly, I'm not proposing that we didn't talk about the weightings. For most companies, they shouldn't have something like 40% of their pay linked to ESG. It's probably 10 or 20% or something of that nature. I mean, it depends on the company. And thirdly, it's not entirely up to the board. The board proposes, shareholders have the power. If BlackRock, in this country, BlackRock, Legal & General, Vanguard, State Street, a few other big people say, no, that's not good enough. It's not happening. So they have the power to propose. As long as we as shareholders use that power and do the homework, we can get to a good outcome. But happy to discuss over a coffee break, though.
Well, thank you, panel. That was really fascinating. You did a great job. Thank you very much. Online. Yes. It's 1:15.
Right, so 2 questions from the online attendees.
You've only got a minute left.
I know, but we can take it in 2 minutes or 3 minutes, right? So one is for Harlan, I think. So he's asking, empirical evidence are showing that hedge funds and activist investors are more short-term investors. So why they would be interested in ESG, which creates long-term value? Or in other words, what is in the ESG that makes it compatible with an activist model? And then one for Shireesh. So given that you are managing assets for a single sovereign client, at which point are geopolitical interests interfering with your ESG investment style?
So one person can have 1 minute to answer 2 questions.
Even 1 minute. And then Shireesh can have 30 seconds of mine. Just like there are many different types of investors, there are many different types of activists. Many of them focus on the short term, absolutely. Some of us focus on the long term. We have an average holding period of about 5 years. It's longer than the average tenure of a CEO in Europe.
So the question was, how does geopolitics comes into the investment framework for us as a global investor?
I think that given that you only have one client.
Only have one client.
At this point, the geopolitical interests interfere.
Sure. I would go back to the principle that I stated, which is our primary objective for our clients is long-term returns and protecting and growing the reserves. So to the extent that any of the investments and any of the geopolitical risks impede those returns in the long term, that obviously flows into our decision making. Our client is fairly sort of financially driven in that respect. So that aligns us quite well with many of these risks. Geopolitics, I mean, one of the sort of great examples is energy security versus energy transition in this environment. And that plays into how we think about our investments as well. So.
Great. Thanks so much.